Yeah, I thought the South Korean signal was fascinating, and particularly the narrative that went with it. And as you say, the concerns about financial stability and too much indebtedness in the economy. But whether or not the Fed will pick up on that in any major way, I'm not so sure. They've been quite dismissive of all that sort of financial stability type challenges over the last 6 to 12 months and longer, in fact. Yeah, I mean, can markets keep making new highs? Absolutely, unless the Fed has to slam the brakes on. I mean, the history of the Fed in the last 12 months, 24 months and beyond really is a slowly, gently, and really remain pretty dovish unless you really have to step up the pace. And perhaps they overdid it in 2018 and moved too fast, and perhaps they learned from that. But I can't see Jerome Powell being in a hurry. And I suspect the statement that he'll make tomorrow will be just a little bit more dovish than the market expects. And I think they'll be a little bit slower to remove tapering than the market expects. And I think all of that will allow markets to keep moving higher. And the reality is, liquidity is not tight, as I said. It's incredibly loose. There's enormous amounts of liquidity sloshing around the system. And that's what's going to keep moving markets higher for now, until the Fed really has to pick up the pace and catch up with with the economy and with rates where rates should be. So for now, I think slowly means the market can keep moving high, keep making record new highs.
Chris, good morning. You said that market's not been greedy, but I noticed your starting point was this year. The market has doubled, or the S&P has doubled off its lows, Chris. That I think your starting point at this 1st of January was a little generous to the fact that the market has had this stunning historic rally, the fastest ever.
Yeah, maybe. But of course, earnings pretty much doubled as well. So, in that sense, the PE ratio didn't move much. I mean, the PE ratio is fairly rich, but not a very good guide for market timing on anything less than a 2 or 3 year basis, really. So, earnings push the market higher as much as liquidity. And in that sense, I don't think we need to worry so much about it. But yeah, sure, I picked my starting point from the start of this year. But markets globally haven't done that much this year. I mean, particularly since February. So what I think is important about that is they've consolidated their gains, those very big gains you mentioned, since Feb March, and the S&P's pushed up a bit more, but other parts of the world have tracked sideways to down. So that's pretty orderly, and they've done it in an orderly manner. So I think that's encouraging, and and I think earnings growth should remain reasonably good from here on out. So continue to be a support for these equity markets.